Folks, thank you so much. This is Prashant Kumar. We meet every alternate weeks, and those who join us, they are always welcome here in this sort of a mastermind meeting that we have. It's a live webinar that we do every alternate Thursdays at 8 p.m. Eastern, and we bring in distinguished guests from the industry to talk about their experiences and the direction in the market and stuff like that. The goal is to create some value for everybody, for the listeners, and just a little bit about myself. And I wouldn't take too much time to talk about me. I come from very strong technology background, right? Um, and one of the great institutes from India, they call it Indian Institute of Technology, IIT. Graduated in 1995. Ever since I have worked in corporate environments in almost all capacities, analyst, coding person, manager, senior manager, director, you name it. I have managed team across the world, but now I am in real estate. I wanted to do real estate. That was my passion. On my personal portfolio, I own about 100 units just for myself. Besides that, I have done, deals in multifamily. I'm doing some deals this year. I did a lot of deals in 2019, and I come from a very humble background. I'm doing something in assisted living space also. We did some work in assisted living space. So the basic idea of this webinar is to create value for our listeners. Okay, as I said, it is selfless work, and we want to create an impact in your life, teach you, to tell you what real estate investing can do for you. And for that, I write blogs myself, and we do these webinars. I have a meetup here in Long Island, New York. So that is all. I don't want to take too much of everybody's time. Today, today we have a great guest. We have a great guest today, and the name of the guest, you see him here, Brian Burke. Uh, Brian is president and CEO of Praxis Capital, right? Everybody's kind of know him very well, and sorry, these people are joining in between. Brian is CEO and president of Praxis Capital. Praxis is a vertically integrated real estate private equity investment firm. Brian has acquired over $500 million worth of real estate in his 30-year career, which includes 3,000 multifamily units. This is an older resume, by the way. I think 3,000 multifamily units and 700 single family homes. He has written a proprietary software which helps him do all this, some of this basically. He has subdivided lands, he has done home construction, he has constructed self-storages, but he really prefers to reposition existing multifamily properties. He's an author of The Hands of Investor, an Amazon bestseller. So if you guys have not read it, get a hand on that book, The Hands of Investor. Hands off. I said hands on. The Hands Off Investor. That's an insider's guide to investing in passive real estate syndications, and is a frequent public speaker uh, in all the real estate conferences and events nationwide. Brian, thank you so much, sir. I really, really appreciate your time. I cannot say it enough how humble I'm feeling that you are taking time to talk to our listeners today.
Well, I'm happy to be here, Prashant. I appreciate the invite to be able to talk to your audience about real estate. It is one of my favorite topics to talk about. We want to touch on a few topics today, and primarily, we're going to mix in a common theme here today, and that's the mindset to creating wealth, and how mindset will help you create wealth, and how that relates to compounding returns and even diversification. And for a lot of people who haven't invested in real estate before, there's going to be some real interesting information. And for people who have invested in real estate before, get your notepad ready, because I'm going to give you some really interesting topics on market selection and some of the things that we're looking at here at Praxis as we're acquiring multifamily units all across the country. So I'm going to run this this discussion under that theme, but using investing in income producing real estate as the base template for what we're going to talk about, and specifically investing passively. And Prashant, it was a great introduction that you gave me. I hope I can live up to everything you said, but you know, you nailed it. After 30 years in this business, 3,000 multifamily units, 750 single family homes, I feel like I've seen it all, and then I find out I haven't seen it all. And you know, I'm still learning just like everybody else, and you'll all be learning as long as you're in this business. So let's do a little bit of learning today. I'll share some of the stuff I've learned with you guys. So in talking about income producing real estate, why do we care about real estate, and how does that relate to wealth creation? I think one of the key things is that there's you know, the old stock and bond portfolio, right? The 60-40 stock and bond portfolio was what financial advisors always preach to their clients, you know, for decades. And that might have worked back in the 1980s when interest rates were at, you know, 10 to 15%, and stock earnings and yields were really high. But, you know, these days, geez, you know, this is, look at 2015 was in the 2s, 3s, and 4s. And now it's even worse. You know, now your interest rates are in the 0 point something range instead of the 2 point something range. So the 60-40 stock and bond portfolio may feel like a safe place to be, and it might be familiar and it might be preached by financial advisors, but it sure isn't going to build you a lot of wealth. Modern portfolio theory kind of took over about 10 years ago, and financial advisors started thinking about how to use real estate to provide portfolio diversification. And the reason that that was important was because it maximized that risk and return balance that everybody's trying to get on the right side of. And it also flattened spikes in portfolio volatility. Everybody saw what happened last year when the Dow was at almost 30,000, and then went to about 15,000, and then went back to 30,000 again. So there can be massive spikes in retail investment portfolios, and real estate helps to flatten that out sometimes. I used to always say that it's interesting to watch people in real estate because, you know, if they came from a stock background, this is a totally different world, because as a real estate investor, I don't have to wake up every morning wondering if I'm rich or poor. And there was a time when I was investing in commodities futures, and literally I would place a trade at about 4 o'clock in the morning, and then I would go to sleep, and I'd wake up a couple hours later and I would wonder, did I lose all my money or did I double it? And I would double it some days until I didn't. And then it was gone. Every bit of it was gone in one day. And that's portfolio volatility. And real estate doesn't do that. And if commodities can turn like a fighter jet, real estate turns like a battleship. It takes time for real estate to move from one direction to the other. You get to see a few warning signs coming, and it's really nice to be able to plan and react and not have to feel like you're always on the edge. Real estate has a lot of advantages that stocks and bonds and you know, and cash don't have. You know, you get higher yields. You can use leverage. You obviously can't use leverage to buy bonds. You can to buy stocks, but boy, you can get margin calls, and you know, there's a lot of risk that you introduce into there. We get tax benefits in real estate that really kind of nobody else gets. And of course, you get equity buildup because you're paying off your loan, and hopefully you're using your tenants' dollars to pay that loan off. So great ways to make money in real estate that help to balance off your stock and bond portfolio. And I'm not here to advocate put all your money in real estate, forget all that other stuff. I think a good balanced portfolio of investments that you understand is what's most important. Now, when people think about real estate, they think about these three things, and I call it tenants, toilets, and trash. Now, those are the kind of tenants you don't want to deal with if they're sitting out on your front porch. everybody's heard about the 2 a.m. toilet calls, and nobody wants that. And then the picture of all that trash is actually what I saw when I opened the front door of a house we bought. That was a total mess. And you think that picture was bad, you should have seen the others. But just because you think of real estate as tenants, toilets, and trash doesn't mean that it has to be that way. There's different ways that you can invest in real estate. One of them is to do it yourself. Everybody knows about investing in real estate on your own. You go and you buy a rental property. It's called direct ownership. There's another way you can do it. You can buy real estate investment trusts, REITs. They're publicly traded. You can get them through your brokerage account. Some of the REITs are not traded. They're a little bit more illiquid, but then there's also traded REITs, which are fully liquid. You can get out, snap of a finger. There's also real estate private equity. Now, real estate private equity is not liquid, and it's also not traded, but it has it can have higher returns and other benefits that REITs don't have, primarily being that REITs are very correlated to the markets. If the stock markets tank, REITs are probably going to tank. If the stock market goes up, REITs can go up. Real estate doesn't work in the same, it doesn't track the same path. You can have private equity real estate investments, or what we call passive real estate investments, that don't track with the stock market. They might, but they don't have to. There's a less of a correlation there. And then, of course, there's an in-between where you buy the property yourself, but then you hire a property manager to manage it for you. And that's kind of a little bit of direct ownership and a little bit passive, but you'll find that there's a lot more work involved when you hire a property manager and own the property directly than if you invested passively. Now, of course, the high net worth people have learned this over the years, and 54%, according to one study, 54% of high net worth investors who do invest in real estate passively using private real estate offerings as a tool. So they're basically handing their money over to somebody else who buys the real estate, manages the real estate, takes care of all the toilets and trash and tenant calls, and basically you're in it like you would be in a mutual fund investment. You make the investment, the mutual fund investment manager picks the stocks, buys the stocks, sells the stocks. Well, this is the same thing, except it's using real estate. The manager picks the real estate, buys and sells the real estate. You as the investor just have to make your financial investment. It makes it very hands-off, which coincidentally was the title of a book I recently wrote, I think you mentioned. Why real estate, and what types of real estate? There's a lot of different types of real estate. There's apartment buildings, there's retail properties, there's industrial, and there's office. Each one of them has their own advantages and disadvantages. From where I sit today, real estate to me looks pretty scary. With shoppers turning to Amazon more and more, and less so much to going to the corner store, you're going to find more difficulty and challenge ahead for retail real estate, maybe even some repurposing, and maybe even some teardowns and reuse. Industrial, on the other hand, is going through the roof. If you're in warehousing and logistics and supply, you need space. Now you got all the weed growers. Now that that's legal, they're going from the backfields of Humboldt County into industrial warehouses in Main Street, USA. There's a great demand on industrial. Office is kind of hit and miss. Office, with the pandemic hit, everybody fled offices like they had COVID and worked from home. So that didn't work out so well for office. So far, they've managed to survive, but I think it's going to be a challenging environment for a little while in the office sector. But apartments, on the other hand, have fared very well throughout COVID, but they've also fared very well throughout history. And looking at this 10-year snapshot of long-term risk-adjusted returns, apartments have dominated. And while the other ones, maybe they've done well, they haven't done as well. So just something to keep in mind when you're thinking about types of real estate. But one of the factors that's helped apartments do as well as they have is if you look at some data surrounding household formation and median incomes, you'll notice that over the decades, median incomes have gone up, but housing average household size has gone down. So, smaller household size means more demand on apartments because smaller households tend to need less space. And that's put a lot of pressure on the apartment sector, and that's created a need for more apartments, which creates a supply and demand imbalance, which creates investment return for investors that are in that sector. Here's an example of property we bought 3 years ago for a little over 18 million. We just sold it for 30 million. And, you know, in 3 years, it almost doubled in value. And that's because there's this supply and demand imbalance on real estate. And it's not an outlying case either. We've got more examples of this very thing. And so here's you know, this property, after fixing it up, we were in it for 23 million. Our returns to investors were 25% internal rate of return net to investor after we took out any splits and fees we were entitled to. And that's why, that's how you create wealth. You don't do it at 0.25% like you'd get in a savings account. It's difficult to do it at 2.5% that you might get by, you know, a stock and bond portfolio that's just, you know, kind of an income growth, safe, you know, down the fairway kind of portfolio. You know, you certainly could get it with Right Growth Mutual Fund. There may be some volatility there, but you could get it. But real estate, you can get that kind of return there too. Of course, I like to say this is kind of an outlier. You know, we think in most real estate investments, you're going to get somewhere in the, you know, 10 to 15% return. 25 is extraordinarily high, but not impossible to achieve. We did it again on another property here that we bought for 14 million and sold for 22 million 2.5 years later. We ended up in the mid-teens return on that, which can certainly create a little bit of wealth. And then, of course, there was this one was 2 properties we bought next door to each other for $40 million 2 years ago that we're now selling for over $62 million. It's going to generate a return to our investors net after everything, somewhere in the mid to high 30% range, we think, which again, it's an unusual outlier. I wouldn't expect that in most deals, but it's certainly when you can get a home run like this, these are the kind of things that help you build wealth. And the trick here is the mindset of making the shift of, I'm going from what's conventional, I'm going from what everybody else is doing, I'm going from what the financial advisors are selling me, to a new concept of, okay, I'm going to diversify my portfolio. I'm going to get into real estate, and I don't have to sit there with the mindset of tenants, toilets, and trash. There's actually a way to invest in real estate without the headaches of tenants, toilets, trash, and termites, and all the other T's involved in real estate investing that nobody wants to have.
And that's a very important thing to note for everybody, you know, those who are listening, is when Brian says that it is passive investing, it means really passive investing. You know, you review your documents, you make sure this project is legit, and then you invest in that project, and then you sit basically, you know, teams like what Brian has or some of us have, we work on these projects day in and day out. We have professionals, you know, and sorry to jump in, Brian, in between. These properties are managed by professional real estate management companies. You know, lender is auditing these projects. You know, SEC is watching it. It's not like hunky-dory game somebody's playing with money. These are being looked at and administered by real professional folks. So what you know, general person can manage a single family home, it's not like that. It's real stuff. And from investor standpoint, they review the reports once a month, once a quarter, and they sit back and relax. If there is a fire in the property, investor doesn't have to go and run after that, right? It's property manager's job to take care of the fire, take care of the insurance and whatnot. So I just wanted to emphasize that point, that passive investing is really, really passive. You know, I have time in the evening for my family, not to go after and look for that property.
Yeah, you know, that's actually a really good segue to 2 things that we should talk about, Prashant. So one of them, you mentioned if there's a fire at the property, the property you have on your screen here, we had 3 structure fires at this property during our period of ownership. One of them took out 2 or 3 units, another one took out 4 or 5 units, another one burned the leasing office to the ground. Yet we still managed to make an incredible return for our investors, and our investors had to do nothing when those fires occurred other than read about it in our reporting. And that's really what passive investing is you don't want to be the one that has to fool with all that stuff. And, you know, to Prashant's point about having a team, that was actually exactly where I was going next. This isn't something that we do alone. I've got a great team of guys that, our senior management here at our company has 106,000 units of multifamily experience with careers going back as far as 40 years. Having those kind of people behind a passive investment is what takes these very difficult and challenging properties to manage and makes it very simple and passive and easy for the passive investor. So it's really important that you're investing with a really strong team that can bring that to the table and manage that investment for you, because these things can go sideways. There's no question about it. So, just a little bit about our company and my background. You mentioned earlier on in the beginning about, how long I've been doing this and stuff. Currently our company's got about 250 million in assets that are under management. We have about 1,500 investors. We've syndicated about 40 different offerings in the past 30 years, with the majority of those being in the last 20 years. But we've survived market cycles. We've survived all sorts of adverse scenarios and managed to do that without losing a nickel of investor principal in all that time. So that's definitely something we're very proud of. Our operational experience spans pretty much across the whole country. We've done deals in a lot of states. We currently own in a lot of states, and our portfolio here is growing. And I took all of this kind of knowledge of what we've been doing as operators and raising money from investors and wrapped that up into a book, The Hands-Off Investor. I wrote, I think it was last year, and came out right when COVID came out. So it's a diseased book, but nevertheless, this book was born partly out of me recognizing all the questions passive investors had about how to properly invest in a deal and not get burned. And I tried to wrap up all that knowledge into this book to teach people the right way to invest passively in real estate, what to look out for, how sponsors can take advantage of you, and kind of what the tricks are, and the secrets behind the curtain. So if you're thinking of investing passively in real estate, I wouldn't do it before reading that book. And I don't say that because I sell the book. This is not how I make my money. I did this to protect the investors, because a friend of mine lost her entire life savings investing in a passive offering with the wrong operator. And I just don't ever want to see that happen to anybody. So this is out here more as a public service announcement than anything else. So I really encourage you to check it out. But let's talk a little bit about real estate. Now, if we take the mindset shift of, okay, I don't have to focus only on retail investments. I can actually open my horizons up and look at passive real estate opportunities. What are some of the things I want to look for in real estate? And the first one is I call location, location, location. Everybody has always pounded into you, if you've ever talked to anybody about real estate, about how location makes all the difference. But I want to change your mindset again here and have you think about location in a different way than you might have been thinking about before. And we're going to take some of the location issues of real estate and we're going to wrap that up in a little bit of a different form and think about real estate of not just being Maine and Maine, but also thinking about where in the country are you going to invest? Are you going to invest in California and New York, or are you going to invest in Arizona and Florida? And there's a big difference between those two, by the way. So I want you to shift your mindset when you're thinking about that. I'm going to talk a little bit about that here in a minute. The other thing we're going to talk about is timing. And I'm sure everybody's thought about timing in the stock market. Day traders think about this all day long. It's the only thing they do. But timing in the real estate market is also important. If you're doing the right thing at the wrong time, you're not going to have a very good outcome. And most people think about real estate timing as being very simple. You buy at the bottom, you sell at the top. Now, I wish it were that easy, but it's not, because real estate cycles don't look like this. They're a lot more confusing than just this very simple buy low, sell high. We wish it was that easy, but it isn't. You've got another cycle at play here, and that cycle is the economic cycle. The economic cycle can expand, it can contract, it can peak, and it can trough. And if you ever saw this, an example of this, you saw it last year when in February, the world was awesome. unemployment was nothing. And then by April, it was horrible and unemployment was in double digits. So the economy can whipsaw on you that fast. And so it's impossible for you to stay ahead of it. You can't get ahead. You can't predict what this cycle is going to be, and you can't stay ahead of it. You can defend against it. And I'm going to talk about a few ways here in a minute, but you can't predict it. But there is a cycle you can predict a little bit more. And that cycle is what I call a demographic cycle. And a demographic cycle is watching population movement. This is a graph of population movement in Buffalo, New York. Look at this. For 100 years, the population of Buffalo, New York was increasing. And then it leveled off, and it stayed leveled off for a quarter of a century. And then it turned negative. And once it turned negative, it never stopped. For the next 75 years, the population has done nothing but decline. Now, if that's not predictable, I don't know what is. It shifts direction very, very slowly. You have plenty of time to react. So I encourage you to think about demographic cycles when you're thinking about real estate. I'm going to show you a few things here of what to think about when we get into the meat of it. Here's a chart of the population of Houston, Texas. Look at this. It's done nothing but go up. So maybe that might be a place to invest if you're thinking about investing, is because look at this population. It's never turned around. So focusing on location, what are we looking for when we talk about location? We're going to do what I call riding the big three. And the big three is looking at job growth, population growth, and income growth. Those three things are what drive income producing real estate. And if you're going to invest in income producing real estate, you want to be investing in places that have these things: job growth, income growth, and population growth. Now, job growth was very difficult in 2020. You didn't see that anywhere, but you're sure seeing it today. Job growth is back, and it's back in a strong way. This is a ranking the Milken Institute puts out every year on the top performing cities in the country. And number one is Provo, Utah, and then followed by Palm Bay, Melbourne, Florida, Austin, Texas, Salt Lake City, Raleigh, Cary, North Carolina, Boise, Idaho, Phoenix, Arizona, Nashville, Tennessee. You got Huntsville, Alabama on the list, Denver, Seattle. These are the places that are outperforming the nation in terms of economic and demographic prosperity. And these are places you should be thinking about owning real estate. Now, of course, there's other factors. And, you got to think about regulatory climates and taxation and all these other things. But this is certainly one thing to look at when you're thinking about location. It's not just Maine and Maine. It's, do I invest in Huntsville or Raleigh, Cary versus Los Angeles or San Francisco? The ULI, the Urban Land Institute, partners with PwC to put out a report every year called Emerging Trends in Real Estate. If you go to uli.org, or if you just simply Google Emerging Trends in Real Estate, you can get this report. You can download it online for free. By the way, go to Milken Institute. You can download the Best Performing Cities Index for free. It comes out every year in January or February. The ULI PwC report usually comes out around December, January. You can read these reports. You'll find in them, in this one that has a chart of markets to watch. Look at number one: Raleigh, Durham, Austin, Nashville, Dallas, Charlotte, Tampa, Washington, D.C., Boston, Long Island, Atlanta, San Antonio. Where do you see Los Angeles on this list, or San Francisco? Actually, I don't think you're even going to. Oh, there it is. Number 60 is San Francisco. So again, when you're thinking about where, look at the markets that are really prospering and think about investing in those markets. Because if they're prospering today, remember, those demographic shifts happen slowly. They'll hopefully be prospering tomorrow as well. Let's look at a few of those markets, though, and some of the why. So this chart, or this table here, shows the best states for doing business. This is put together by Chief Executive Magazine. And the reason that I like it is because business-friendly policies tend to lead to economic expansion. Economic expansion tends to lead to rent growth and stability. And so when you look at these cities of, who's kind of being the most friendly to businesses, Texas, Florida, Nevada, Tennessee are coming out in the top. Arizona's up there pretty high. Utah, Georgia, Coincidentally, these states are also doing really well in real estate. So those are places to look. But not only are they doing well in real estate, they're also, interestingly, doing really well in inward population migration. And look at this. People are moving to Dallas, Phoenix, Vegas, Tampa, Orlando, Atlanta. Remember, if you go back to business friendly cities or business friendly states list, look, Texas, Florida, Nevada. You go over here and where are people moving? Oh, Texas, Florida, Nevada. What a coincidence. Well, that's why they're moving there, is because businesses are moving there and the employees are following them and the housing costs are more affordable and it's just an all-out better place to live. So those population trends are probably not going to reverse themselves in 6 months. So that might be a good place to invest in real estate. Fastest growing states, if we look at, where are those drivers? Where is that job growth, population growth, and income growth? Well, population growth, by percentage increase, Idaho was #1. Okay, it's a small state, so maybe that's not a lot of people. But Nevada is up there, Arizona is up there, Texas, Florida, North Carolina. We're starting to see a common theme here, right? That's what we're looking for. It's like, where is all, yes, all roads lead to here. No matter how you look at it, you're ending up in the same place. That's what you want to see. You want to go to where you're seeing these things in multiple places. That's a good place to be. Population growth by sheer number of people. Texas, there's more people moving to Texas, Florida, and Arizona than anywhere by number of people. Georgia's up there. Look at that. South Carolina, Tennessee, Nevada. Again, the usual suspects, those business-friendly states. Fastest growing metro areas. Well, where in these states are they going? Well, they're going to Dallas, Phoenix, Houston, Atlanta, Austin, Seattle, Charlotte, Vegas, Tampa, San Antonio. This is the place that people are moving to. And these are the cities within those states that you might want to be paying attention to. Here's another one that I find kind of interesting, studying one-way moving truck rental destinations. Penske Truck Rental and U-Haul Truck Rental both put out studies every year, and they come out usually in January or February. You can get them online. They will show you the top one-way truck rental destinations. That's what Penske shows. And U-Haul shows a ranking of destinations that are receiving the highest ratio of inward truck rentals versus outward truck rentals. And so if you look at the Penske ones, people are moving to Vegas, Phoenix, Denver, Austin, Atlanta, Houston, Orlando, Dallas, San Antonio, and Tampa. Same exact list that was on the Census Bureau's data, right? And then you look at U-Haul Truck Rental. Well, where are people moving into but not moving out of? Northport, Florida was #1. It's in the Sarasota market. Kissimmee, Florida, that's our Orlando market.
Guys, I'm in an investment seminar, which is really good, by the way. Yeah, I'm in a Zoom seminar, so I'm sorry, I'm going to have to call you after. Let's just reconvene tomorrow.
No
Thank
problem.
you. Sorry, guys. It's really good.
Yeah, happy to do it, Andy. No problem. Now, if you'll notice a lot of these are in yellow, and the ones that are in yellow are markets that we're specifically targeting. And so that's what we're really looking at. Where are we investing? We're investing in these yellow markets. Well, why aren't we investing in the white markets? It might be because there's a regulatory challenge that we stay away from it. It might be because there's not a lot of volume there, like Port St. Lucie, Florida, for example. Small market, not a lot of transaction velocity. Great market to go pick up some single family homes, small duplexes, and that sort of stuff. For a company like ours who buys pretty much only 100 unit and up multifamily properties, there's just not enough of them there to give us enough transaction velocity. Let's take a look at some of what I call the top post-COVID rent growth markets. Now, these are markets where Axiometrics, a fee-based economic research firm, puts together they put together rent growth forecasts going into the future. And I like to compile that data and go through it and find a list of where is the highest rent growth expected in what markets are those expected. And Tucson, Arizona leads the country, followed by Phoenix, Reno, Cape Coral. I found I didn't go 1 through 10 here because some of them weren't all that interesting. They were markets where, you know, horrible regulatory climate or whatever the case may have been. But I picked out a few others that I found in the top that are markets that I like Atlanta, Georgia, you know, Raleigh, Durham, Las Vegas, Charlotte. Those are really interesting markets to be in. Both from regulatory perspective, but also from job growth, income growth, and population growth. Definitely markets where you might want to be looking. Now, what I call a post-COVID rent growth market is a market where the rent growth from 2022 through 2024 is the highest. And I'm assuming by 2022, all this pandemic stuff is history. And now we're just dealing with regular market forces. And I want to look at markets that are going to outperform during that recovery cycle. So now what about strategy? You can't just go invest in real estate in these markets just because, you know, we saw a bunch of charts from U-Haul. You got to go into these markets and think about what are you going to invest in and how is that investment going to work? And there's literally hundreds of different strategies. I mean, you know, you could invest in single family, multifamily, hotels, office buildings, industrial, warehouse, self-storage, but you can also mix and match. And why might you want to do that? Remember that market cycle chart I showed you at the beginning where you buy low, sell high? Well, this is what the market cycle in real estate really looks like. There's a lot of different cycles and they're all out of phase with one another. They're all trading in completely different directions. And you could have multifamily is nailing it and you could have retail in the toilet. You could have industrial is really rocking it and office is only so-so. And all this can be happening at the same time. You can also have a scenario like, and we're seeing this today. Here's a great example. As we sit here today, rents in San Francisco in apartments have tumbled, but rents in apartments in Phoenix have gone through the roof. At the same time this is happening, you've got retail that's suffering because of closed businesses. You have office that is suffering because of closed businesses. You have hotels that are suffering because of pandemic travel restrictions. And yet multifamily is firing on all cylinders in some markets, but not in others. So you've got all these different things happening at the same time. Now, how do you defend against that? You defend against it with diversification. Invest in multiple asset classes, in multiple geographies, with multiple sponsors in charge of the deal, and you can eliminate any single point of failure. That's the objective here. When you're looking at deals, you want to be creating a funnel and you want to look at a lot of deals. You know, we look at about 500 or more properties before we'll bake that down to 100 properties to underwrite, before we bake that down to 10 properties to write an offer on, before we bake that down to 1 acquisition. It takes a lot of work. And that's why investing passively is such a key thing for people who are trying to build wealth, is you can leverage a lot of things I'm going to talk about here in a minute that can enable all of this stuff to still happen without you having to dedicate your own personal resources to making it happen. At the same time, you also get to have some tax advantages. You get depreciation to offset some of your income. It's important to not pay Uncle Sam as much if you don't have to. You can get capital gains tax treatment, at least until the current administration outlaws that, which we'll see if that actually passes or not, hopefully not. But right now, the way the law currently reads, capital gains are taxed at a lower rate. So real estate gives you some advantages that way. You can also invest in real estate using retirement funds through a self-directed IRA, a solo K, or a pension plan if you have the right kind of plan. So you can capture tax advantages and still be passive up to a point. So remember, we've got these 2 options of, you know, do you do this yourself or do you have it done for you? Well, assuming that you want to have it done for you. Now, if you do it yourself, great. You go out, go find some real estate, make an offer, get financing, hire a property manager or manage it yourself, and you're in the real estate game. 100%, you'll be way far ahead of most of the people that you know because they probably didn't plan that far ahead. And you're there to build wealth and you're there to buy a property, refinance it, use the proceeds to buy another property and compound those returns by having all that capital making capital that's being reinvested to make more capital. That's what this is all about. But you don't have to do it yourself. You can have it done for you, but if you're going to trust somebody else to do all the hard legwork for you, I want to show you a few things to look for, and I want to show you something to watch out for. So let's first start with 5 things I want you to look for. One is I want you to look for a good, strong team. You want a team that has experience, and I mean market cycle experience, full cycle experience, which means they've bought, they've owned, and they've sold. They've been all the way through the process. You want to look for people that have local market knowledge and experience in the product type. Be careful about investing with someone in a hotel deal who has only done multifamily, and vice versa. Each one of these is a unique animal, and you want to make sure that there's experience across the board on the product type you're investing in. You also want to know that the team has a good, solid track record and that they have a brand to protect. So they're going to fight hard to protect your money because they have a reputation that they have to fight hard to protect. The other thing I want you to watch out for is the suitability of the investment. And by that, I mean, you want to know that any investment you make, and this counts whether it's real estate or otherwise, that it meets your needs. That if you are looking for cash flow, you want to invest in something that's producing cash flow. If you need capital growth, you want to invest in something that produces capital growth. And this may sound obvious, but you'll have people who are retired and looking for retirement income investing in a ground up development deal that produces 0 cash. And that does not fulfill their investment objective, and it's the wrong investment for them to be in. So making sure that the business plan of the investment fits with your plan is enormously important. You also want to know that it matches your risk tolerance. And if you have no tolerance for risk, you don't want to be investing in ground up development. If you have a high risk tolerance, you might not want to be investing in core, brand new core multifamily assets. Also, you want to know that the liquidity matches. And if you have money that you need in 1 year, don't go invest it in a deal where it's locked up for 10 years because you're not going to have a way to get out of it. And you don't want to be stuck if you had a need for that capital. So watch out for all of that. Watch your markets. We talked about this already, job growth, income growth, and population growth, but also make sure that that's underscored with economic diversification. Be aware of those one-horse towns. An example of that might be like Midland and Odessa, Texas. They got job growth, they got income growth, they got population growth, but every single one of those jobs and all that income is made in the oil industry. And if all of a sudden oil prices tank or the oil industry goes south, that whole town gets cleared out. So watch out for, watch for economic diversification. Look at your real estate, look at the location, look at the quality, and look at the strategy. Make sure that all of those things meet your needs and it's what you're looking for in an investment. And finally, look at the assumptions that are being presented to you. And if you're investing in a passive offering, the company that you're investing with is going to show you some projections, just as if you're going to invest in a mutual fund and they're going to show you a projection and they're going to show you historical returns. A passive investment operator is going to show you assumptions on a property and say, this is our projected rent growth. This is our vacancy factors, all of these things. Look at the assumptions that they're presenting to you. And what you want to make sure is that those assumptions that they're making are realistic, because if they're not, the return projections that they're making to you are not going to be met. It's going to fall short. I wrote a whole book, 350 pages, on this slide right here. So if you're not sure what to look for on these bullet points on this slide, go pick up a copy of the book and read about each of these things and what you're going to look for, what's right and what's wrong, and what's a major red flag. That's what you want to know before you get into a passive investment. And the one, promise you that I'd tell you one thing to avoid. The one thing that you want to avoid is you want to avoid shiny object syndrome. This is what I call someone's tendency to gravitate towards one thing. And this is how this works. You go to a crowdfunding website, for example, and you get a grid of available investment opportunities. And there's 20 different things for you to choose from. And the natural tendency is to go, I'm going to pick the one that has the highest projected return. And that could be the worst mistake you can make. Don't get lured into a shiny object like a high projected return. Instead, you need to look at the assumptions that went into making up that projected return to even establish whether or not their return projections are realistic. You also need to balance the return to your risk tolerance and recognize that higher returns tend to come with higher risk. Lower returns, hopefully, come with a lower risk profile. Match those two for you. But just remember that their projections are everything. And if it's garbage in, it's garbage out. Now, let's talk a little bit quickly about why you want to invest passively versus actively. I showed you a lot of stuff to look for. I told you about markets. I told you about underwriting. I told you about assumptions. I told you about 500 deals that goes down to 100, that goes down to 10, that comes to 1. How do you manage all of that? You manage it with leverage. When you're investing passively, basically what you're doing is you're hiring a firm to do all of the work for you. You're leveraging the sponsor's knowledge, you're leveraging their skills to make the right investment in the right place at the right time. You're leveraging their experience to source deals that you couldn't source on your own, and their contacts and their network to source deals you couldn't source on your own. You're leveraging the sponsor's financial strength to qualify for loans that maybe are larger than you could qualify for on your own. It takes a $10 million net worth to get a $10 million agency loan. That sponsor can bring that net worth so you don't have to. That's part of what the services that are provided to passive investors by investment sponsors. You want to leverage the sponsor's market research. You want to leverage the sponsor's time to execute the business plan and search for property. You want to leverage the capital of the other investors to invest in a deal that's larger than you could invest in on your own, or larger than you want to invest in a single deal on your own. Instead, you'd rather spread your money out. So instead of putting $2 million into one property, you could put $100,000 into 20 properties and still have the same amount of real estate, but have an incredible amount of diversification. That's what passive investing allows you to do, but still get the economies of scale of the larger investments. So it's just important that when you're looking at investing passively, that you choose who you invest with carefully, and that you make the right choice. Underwrite who you're investing with, because it's more important than what you're investing in a lot of circumstances. I always like to say a good sponsor can finagle the best outcome in the face of adversity, and a bad sponsor can destroy a perfectly good real estate deal. And if you're not sure how to do that, again, I don't want to beat this up too much. Pick up a copy of The Hands-Off Investor to show you what to look for when you're investing in a passive real estate offering. And Prashant, that's what I had for you today. And I know that you had promised me that we could open this up for questions so that people could run me over the coals and make sure that I really know what I'm talking about. So I turn the floor back over to you, and I'll let you lead me out from here.
Sure. Okay. Yeah, Brian, thank you so much. This was a lot of information in a very short amount of time. I know it is going to be overwhelming for some of the new folks, and we are going to start the Q&A session in about 2 minutes. But before that, I would like to just share a small deal that came across my table just half an hour ago. We just signed it up today, so I thought it would be a good opportunity to just kind of share it. We will have a webinar for this deal next week, next Thursday, same time, and you will get an email for that. But I just want to share at a very high level what it is, and it will not, trust me, it will not take more than 3 minutes. So there is a small deal that usually we don't get involved into smaller deals like this, but this is something which we had been tracking for some time, and we have great team on the ground in the 6th fastest growing state, South Carolina, is Columbia, South Carolina, C-class asset, 64 units, very small deal. But from an investor standpoint, doesn't matter, it's a big deal or a small deal. It gives diversification. And that's why, we got involved in this. And again, I'm not taking too much time. It's just for entertainment purposes. A little bit about, Columbia, South Carolina, not going through these slides. Future growth, we have tracked all the measures, which Brian had talked about, what has been the job growth in past, what has been the unemployment rate, what is going to be in future, how the future stands. So most of those measures have been, we have looked at. At a very high level, it's a 7% pref return deal, about 5 years return and teen IRR. I mean, on the conservative side, I think that's a reasonable projection that we have. And basically, 64 units, relatively new product, not before 1980. That's always something that we look for, nothing below 1980. Overall good unit mix, half and half, 2 bedrooms and 3 bedrooms, bigger space for folks to live in. The important thing that we like about this deal, it's already upgraded. Most of it is already upgraded, and the rents are much below market. We can potentially go in and just raise the rents, 5% easily per year. And as I said, IRR is about 18%, 5 years, it kind of doubles the money for our investors. And that was not the purpose of this webinar, but I just wanted to kind of throw it out there that it doubles our money on a conservative side. And these are the conservative numbers that you see. We have budgeted for $250,000 for rehab in this. I don't think we need that, but even after raising that much also, it gives us 20% annualized rate of return. Those who need more information about this deal, we will have a webinar next Thursday, same time. But drop me, in the chat box, please drop me your email address so that I make sure that you get the invitation for that webinar. So that was the only purpose to share it, because it's a closed group, the 506B, and I have substantial relationship with most of you. That's why I shared it here, although I would not have done it. Yeah, that's all. I just wanted to share it. And now the floor is open for Brian. Question and answers, a couple of minutes, folks, be mindful for the time. Like to finish it on time, or a little bit after time is okay too, but anybody has any questions?
Yeah, and I've also got the chat box open, so if you don't want to unmute yourself and ask a question, you can feel free to type it in the chat box. I can see the comments there in the chat box, and I'll watch for that. But if anybody has anything they want to toss out, just feel free to. I think they can unmute themselves, right, Prashant? And they could.
Yes, they can. Yes,
right.
It's an open forum, guys. Anybody wants to ask any questions, feel free. Not a lot of questions.
That means I answered them all.
Yeah, I know. Yeah, it's great. So
I'll jump in.
Okay.
And sorry for the interruption earlier.
No worries.
And I was actually telling my team member I'm in a great investment seminar on Zoom. So call you guys later. So thank you. Hey, so how do you guys have to have accredited investors, non-accredited investors? How can one invest in some of these syndications?
Yeah, it's a great question. And before I answer it, I'll first answer what an accredited investor is. There's no test that you have to pass to become an accredited investor. You don't get a certificate. There's no wallet card. An accredited investor is simply someone who earns over $200,000 a year, or a married couple that earns over $300,000 a year for the last 2 years and expects to continue to do so, or has $1 million net worth, not including their principal residence. There's a few other exemptions that allow for you to be an accredited investor. The list does go on and on and on, but I would say about 98% of accredited investors are that, because they've met one of those 2 simple tests. Now, when you invest in a private offering is a restricted offering that does not require you to publicly register the securities with the Securities and Exchange Commission. So if I have a corporation that I'm going to take public, I have to register that stock with the Securities and Exchange Commission. It's a very expensive process to do so. But for these real estate offerings, it's cost prohibitive. There's no way you can make it work. So instead, what you do is you rely upon an exemption in the securities laws that allow you to offer securities for sale without registering them. The exemptions are listed under Regulation D of the Securities Act, and it's primarily Rule 506C and Rule 506B are the two main exemptions that real estate companies rely upon for them to sell securities without registration. Now, the key distinction is if you're using the 506B exemption, it prohibits you from advertising your investment. You can't put a billboard on the freeway. You can't, announce it on your podcast and tell everybody in the world. You can't take out radio station commercials. You can't do any kind of general solicitation about that offering under the Rule 506B exemption. And as long as you follow that and you're not advertising, then you can sell securities, but there's no limit, and there's no limitation. You can sell them to non-accredited investors or accredited investors. So you can sell to an unlimited number of accredited investors, and you can have up to 35 non-accredited investors in your offering. Now, if you do want to advertise, and whether that means, you want to put it out on your blogs or a billboard on the freeway or whatever kind of advertising you're going to do, you can now do that. This wasn't legal 6 or 7 years ago. I think it was 2016 or, it was a few years ago, they made it legal to advertise your private offering. But if you do, you can only allow accredited investors in your offering. You cannot have a single non-accredited investor invest in your offering. And you also, the sponsor is required to take reasonable steps to verify that each investor is in fact accredited, which means you've got to show them your tax returns, W-2s, a letter from your CPA, or hire a third-party verification service to do an investigation, and then write a letter certifying you as being accredited. So that's the distinction. So some sponsors will not take any non-accredited investors, and it's probably because they're relying upon the 506B exemption. They're not advertising, and it allows them to take unaccredited. Now, why would they do that? Oftentimes, sponsors find it's much easier. They don't want to inconvenience their investors with these onerous validation requirements under 506C for the proof of accreditation, or perhaps they don't know a lot of accredited investors and they're raising money from friends and family who maybe aren't accredited, and they still want to be able to take their money or whatever the case may be. So there's reasons for using each. And different sponsors, even with different offerings, will have different requirements as to whether investors need to be accredited or not. So the knife cuts both ways. There's a question in hopefully that answers your question, Andy. If not, feel free to just pop in and I'll follow up on it. But there is a question in the chat box that says, why does Praxis Capital not take investors looking to place 1031 money into its syndications? That's a great question. Well, first of all, you can't take $1031 directly into a syndication. It's not like kind. So in other words, you can't sell an office building, take $1 million from that sale and roll it over directly into an apartment syndication, because they're not like kind. And I don't mean office isn't like kind with apartments. What I mean is the real estate you sold is not like kind to the paper securities that you're buying when you're investing in a syndication deal. When you're investing in a syndication, you're not actually buying real estate. You are buying securities, which is a personal property asset. It is not a real estate asset. Therefore, it is not like to like. Now, there are ways around it. You could have a Delaware statutory trust, which is a way to take title to real estate that does allow 1031 money, but they have a lot of restrictions upon how you can manage that asset, and it makes it very difficult in a lot of circumstances. That could be a topic of a whole additional webinar on the nuances of Delaware statutory trusts. You can also do a tenants in common, and there's a couple ways you can do that. One is you can do a tick sidecar to a syndication. And what that means is I would say, okay, 1031 investor, I'm raising $5 million. You have 2.5. You put your 2.5 in, you'll own 50% of the property. I'm going to syndicate the other 2.5. My syndication will own the other 50% of the property. That's the common way that it's done. I haven't done it because I have so much money coming from passive investors into the syndications. I don't need the 1031 dollars to round out our offerings. We have no problem raising money. And it's a headache. It creates additional management challenges for the operation. It creates additional risks for the syndication investors. And it just adds additional challenges. Now, it certainly can be done, and there are companies out there that will do it. I have not yet done it, and may never, and I never say never, so maybe I will too.
Very good. That's a great explanation, Brian. A lot of people do not know what TICs are, and they don't understand that they are selling a house or an office and they are getting into multifamily syndication. It's really a security, not the real estate. So it's not an in-kind exchange, so to say. So yeah, it is. I mean, I would agree. When you are saying it anyway, it's an extremely complicated process. I mean, you try to do it for your single family home. You buy one single family and replace it with another single family. You have to go through hoops. You have more paperwork in doing that than really selling your home.
That's one of the challenges too, Prashant, about the 1031, and makes it difficult for us at requiring real estate as a syndication sponsor or even as a fund. And we're now moving off of the single asset syndication model and more of a fund structure here at Praxis. But it's difficult because if somebody comes to us with 1031, they also are coming to us with a fuse that's lit and it's burning and it's going to run out very soon. And there's time constraints surrounding 1031 exchanges. So if you have a 1031 exchange, you have to find a syndication investment that's going to be closing at the right time frame, that's within your timing constraints, also that is of the right price, that is within your price constraints and your financing constraint, because a 1031 might mean you have to buy a property that's more expensive than the one you sold, that has a larger loan than the one you sold, and that counts to your proportional interest. So if you're only buying a 25% interest, that means what you're buying has to have a purchase price 4 times greater than what you sold and a loan that's 4 times greater than what you paid off, or you get taxable boot. And, people are trying to avoid the tax anyway, which is why they're doing it. So there's a lot of nuances around all of that make it just challenging to execute. That's the biggest issue.
Yeah. So folks, any more questions? We are almost, we have been talking, Brian. I don't know how you talk. You were talking for almost an hour, like a jet speed. You had to cover so much content today.
There's a lot to cover.
Yes, it was indeed a lot to cover. I hope, I'm pretty sure. For me, it is eye-opening. Even though I'm a syndicator, I've been doing it for last 6-7 years. But the amount of information that you presented is really, really incredible. So any more questions, guys? One last call. Give me a second. Yeah, looks like there are no more questions. Guys, Vavi, you want something to ask? I see your hand raised. No, he took his hand off. Okay, all right. So guys, you have heard it, from the best today. I hope this created a lot of value for you guys. I'm going to share this recording in next 3-4 days with everybody. Please look out for an email invitation for a webinar for next Thursday, approximately same time, 8:30 Eastern, for the deal that we are bringing to the market. Just a small deal, but I think it is an incredible deal for those who want to invest in the real estate syndication. But other than that, is there any question here? Are these independent services that would analyze an offering for you for a fee?
I'm not aware of any. That's a really good question, and I'm not aware of any. And one of the reasons why I wrote the book, right, is to teach people how to make that analysis, because I haven't seen anybody out there that's doing it for you. Now, there are groups out there that you can participate in. I think I've heard Real Estate Crowdfunding Review is one of them. The 506 Club is another one. These are groups of investors where it's kind of a community that shares information with one another and evaluates these opportunities. But there's no like, you know, hey, if I give you $1,000 for you, tell me if this is a good deal or not. A lot of downside for a fee consultant to do that. If they give it the thumbs up and then the deal goes south, that could create a real liability exposure for that consultant.
Yeah, yeah. No, that's true. I mean, anybody, yes, there could be an underwriting service who can underwrite it for you, but ultimately the decision to do it is yours. And that is, I mean, to Brian's point, there are a lot of groups, you know, you become part of it, kind of do the consulting within the group and take your own decision, right? I mean, that's really the best way to go about it. Or have a mentor who can work with you to help you out in your deals if you are a syndicator and want to do so. All right, Brian. Again, everybody, thank you so much. And Brian, I'm humbled. Thank you very much for your time.
You got it.
I look forward to talking to you again sometime in future. Hopefully we can talk about some other topic, maybe meditation. You know, I meditate by the way, so I like to talk about that all the time. Yeah, I mean, I would love to pick your brain about real estate some other time also. And
happy to do it. Thanks for having me on, Prashant. I appreciate it. Aloha.
Yeah, thank you so much, sir. Thank you
got
very
it.
much, everybody. And I'm going to send this recording to everybody. Everybody will have it.